Okay, as we march towards the opening bells on this Monday morning, let's continue our conversation now with David Rosenberg, founder and president at Rosenberg Research. And David, there'd been this narrative in the markets through a good chunk of the final stretch of 2023, and even now, that the inflation picture is improving, that interest rates are coming down. I think a lot of this is, we just talked about Canada, but a lot of this is seen through the lens of a U.S. economy that is navigating relatively well, and that's generally a good environment for stocks. I think I know how you feel about the outlook from here versus what the market narrative has been, but what is your general sense right now?
Well, look, you know, people say to me all the time, like, they call me Rosie. They just don't call me Rosy Scenario. So they say, Rosie, the market's at a 2-year high. Like, when are you going to start turning bullish? And I start to think, yeah, it's exactly right. The market is basically where it was 2 years ago. Think about that for a second. It's just been a roller coaster ride. It's been a meat grinder of a market. The bulls aren't happy. The bears aren't happy. I mean, if you want to look, since the October lows, we're up double digits. But then again, over 2 years, really nothing. And I think that a lot of the rally off the recent lows, I mean, it's been very impressive, and it has broadened out. But a lot of the broadening out outside the Magnificent Seven was really, a short covering rally. And I think, yeah, you're right. A lot of it is just, John, it's sentiment. It's sentiment driven to a large extent. And remember, the stock market is a psychological animal. And it's being driven by an expanding market multiple. What's happening with earnings revisions right now? They're going down. And here's a big problem for 2023 for the S&P 500. Embedded in the forecast is 11% earnings growth for this year. I think that we're going to be lucky to get low single-digit growth. So I think that we're already fully priced right now. But the big risk is that earnings expectations come down. And I think that's what undermines the market. Once that realization, just like Canada, the bottom line is that, like I said before, the stock market is driven by a lot of things. Sentiment is very powerful. Okay, what's the sentiment right now? Sentiment right now is there's no recession. Sentiment right now is that we're going to have this elongated soft landing. Everything will be okay. So if you have that view, I would still say you're fully priced for that view, but go ahead and run with it. But if we do get an economic downturn, which I think is logical, in recessions, the stock market's down 20%.
What should people make of levels for yields? So last year, when people were not convinced that the rate hiking cycle was over, you saw that reflected in bond yields, and then that kind of creates this dynamic where investors have to decide, well, do I want what the bond market is offering, a higher yield here versus stocks? If we're in an environment where there seems to be some growing consensus that interest rates will go down and that will impact yields in the fixed income world, and that is a world where, correct me if I'm wrong, but you were suggesting in past appearances maybe lock in some of those yields.
Yep.
Is that not the kind of just sort of head-on math that can help equities in the short term?
Well, I think that you could explain part of the rally in equities has come from the fact that bond yields have been coming down, but the math still doesn't work, and I'll tell you why I say that. It comes down to this acronym called ERP, Equity Risk Premium. And what you're doing is you're looking at the earnings yield in the stock market versus the bond yield, say, that you get in the treasury market. Well, that equity risk premium historically, most of the time, is between 300 and 400 basis points. You get compensated to be in the equity market. You get compensated for that risk. That ERP is now 100 basis points, John. Okay, it's not zero, but you're still, I would say, the risk reward, even after this big rally in bonds, very big rally in bonds since October, the risk reward is still more in the government bond market than it is in the stock market right now. That equity risk premium is a classic mean reverting series. And so if you believe, by the way, if you believe the stock market's fairly valued right now, ipso facto, you have to believe that the 10-year note yield should be down to 1.5%, because that's how the math works. That's how you would mean revert that ratio. Ergo, I'm still, relatively speaking, much more bullish on the bond market than I am on the stock market.
What about the gold market? You had said at the end of last year you were pretty upbeat on the outlook for something like bullion. And is that in part because, not only are we navigating uncertainty on the economy in the short term, but I think there's this broader conversation about fighting inflation over the longer term, and people may lean into assets that play into that the idea of sort of this lingering inflation
No,
challenge?
I don't buy into the inflation argument. We could say that there'll be a temporary blip because what's happening in the Red Sea and so on and so forth, impact on global transportation costs. But I think that the inflation is coming down in a recession. It'd be very unusual for inflation to be going up. I'd say, what is gold? What is gold? Gold is basically the hedge against the risky aspects of your portfolio. It is an insurance policy. And let's face it, we are in an elevated level of global uncertainty, not just on the economy, but on the geopolitical front. So I'd say that gold always and everywhere, a very good hedge against global instability, and we're seeing that in spades right now.
And then in recent months, we had seen a stronger Canadian dollar against the U.S. dollar. At the same time that gold was gaining some ground, you'd sort of finally started to see a changing narrative around the American currency. How are you thinking about, let's say, the loonie in an environment like this?
Well, look, the Canadian dollar got a bit of a lift. It's fun to trade because of what happened with oil prices coming off the lows. And curiously enough, even though the Canadian economy is in far worse shape than the U.S., there's more rate cuts priced into the U.S. bond market than there is in the Canadian futures curve. So there's some aspects to this Canadian dollar rally that I would resist. I think that the Canadian economy, very high chance it's going to underperform the U.S. Secondarily, what's Canada? Canada is a small open economy that's a torque on global GDP. You just had printed negative numbers on Q4 German GDP. China is in a mess. The U.S. is going into a recession. Going to be difficult for the Canadian dollar to rally in that environment.
Okay, we only have about 30 seconds, but we're on a roll here. On the oil front, because we had a guest this morning who says we're sort of in a longer-term environment that would be supportive of crude prices. How do you feel about oil?
I think oil is in a range, and with all these promoters and sponsors of the oil price, let me just say, they were saying months ago we're supposed to be at $100 oil. Like the OPEC Plus was cutting back. We had these problems in the Middle East. And we're $70 in WTI. Where's the $100? So I'm a little skeptical. Look, I would just say commodities that are cyclical in a global recession, not things that you want to own. If you want to own a commodity that does not have anything to do with the economic cycle, that actually has long-term supply-demand, very solid fundamentals, okay? Uranium, all right? Uranium, okay. Oil is just too cyclical for my liking right now.
And obviously
And uranium, by the way, huge fundamental bull market. And it has nothing to do with the economic cycle.